Okay, to get you started on project 2, the first thing you need to do is create what we call common size statements. A common size statement is simply a statement where every item, whether it be cost of goods sold, direct costs, or balance of long-term debt, is forecasted as a percentage of total revenue. So you can see that I've created a 5th tab. Right, I have my as reported statements, I have my standardized statements, my dividend history, my weighted average cost of capital, which you just completed, and now I've got my common size statement. So in order to start my common size statement, I go back to my standardized statements and I grab the income statement and the balance sheet. We're not going to do anything with the statement of cash flows at this point. I'll copy it and bring it over. I'm going to double click this line separating column A from column B so that A automatically resizes. All right, so we would call step 1 would be copy and paste standardized statements, income statement and balance sheet. Right. The second thing that we're going to do is we're going to do some cleanup and formatting. When I say cleanup and formatting, what I mean is getting rid of some rows. I'm going to get rid of this piece that it says about the exchange rate. I'm going to get rid of my currency, I'm going to get rid of my audit status, and I'm going to get rid of the row that specifies consolidated. I'm going to do that for both of these. I'm going to leave my scale just because scale can come back to haunt us. Perfect. Then I'm going to clean up getting rid of these columns where the data is empty. If you've done forecasting before, you might have forecasted in these columns. I prefer not to. It gives you just a much more unwieldy common size statement. We'll delete those. Okay, there we did our cleanup. There we've done our cleanup. And then 3, we're going to set up the common size statement. So to do that, we're going to just bring over our dates and our scale. No, not what I wanted. Stop it. Okay. And we'll bring that over here and here. So now we've got a setup for our income statement and our balance sheet. So if you've done forecasting, if you created common size statements for your accounting class, there's going to be some similarities and some differences. So if you actually look at this and think, oh yeah, I have some vague idea how to do or what a common size statement is, that's probably the best, because then what I say won't confuse you because you only have a vague recollection of what you did before, and we'll call it good. When we set up the common size statement, we want to forecast everything, or I'm sorry, we're not going to forecast. We want to calculate everything, each item, as a percentage of total revenue. For Hershey's, this is fairly straightforward. Hershey's has one form of, or one revenue stream, right, from sales. If you're working with a movie studio or Disney, or there's a lot of big companies, they may have 3 or 4 revenue streams. In that case, everything is going to be a percentage of total revenue. So I will take sales revenue in 2013 and divide it by total revenue in 2013. But I want to make this easy on myself. I don't want to have to calculate this equation, right? Direct costs divided by that year's total revenue for every single one of these items. I'd just like to be able to drag it. So to set that up, I leave the numerator with a relative reference, but in the denominator of total revenue, I change it so that it's got an absolute reference in front of the row. I want to let the column vary, but I want to hold the row constant. So then if I drag these over and I drag them down, it should automatically populate. And then to make sure that I've done what I want to do, I will double click in a few cells. So here, operating income for 2011, this percentage is operating income divided by total revenue. That tells us that in 2011, for every dollar of total revenue, it cost them about 17 cents, or I'm sorry, it didn't cost them about 17 cents. They ended up with about 17 cents of operating income. We'll do the same thing for the balance sheet. In the balance sheet, each item is forecasted again, or it's not forecasted, is calculated as a percentage of total revenue. This is where it's different than what you would have done in accounting, because in accounting, everything on the balance sheet is looked at as a percentage of total assets. So if you've done this correctly, you can drag it over and then drag it down. And each of these items, for instance, cash and cash equivalents and short-term investments, that's the total of cash and cash equivalents plus any short-term investments, which Hershey's doesn't have, so these two numbers are the same, divided by that year's total revenue. I might check that in a couple of places to make sure that I'm referencing, if I'm in 2009 column on the common size, I want to be referencing accumulated depreciation here in 2009 plus total revenue in 2009. I do a couple of checks in various places. If it all looks good, I'll set these up so they're in a percentage form with 2 decimals, and that's my common size statement. Pretty easy, huh? Then we can look through and you may notice that you have some rows that are 0 for the entire time, right? Hershey's has never had other operating expenses as they've categorized it on their standardized statement, or other non-operating expenses, or any extraordinary items, any accounting changes, nor have they had preference dividends or similar. I'm just going to delete them, right? If it's 0 in every year, you delete them. Then after that, we're not going to need anything below net income on the income statement. Don't delete it, just hide it, in case we want some piece of information from that later. Then on the balance sheet, I'll do the same thing. If I have anything where the year is 0, where the totals are 0 for every single year, for instance, Hershey's never reported other current liabilities, I'm going to delete it. However, the funny thing, or the thing that we need to work around, are these value items, right? It's just a value because if it won't give you an answer if there's nothing divided by another number. So go in, and wherever there's a dash, you'll know there's a dash because it corresponds to a number here that says value. If you change it to 0 instead of a dash, it'll change that value into 0%. And we're going to find that that is helpful later. So the last thing that we have to do, now that we've calculated or created our common size statements, I'm going to make this column small. I want to get the average value for each year. The average value for all 5 years for each category. So average function of all these values. So on average, sales revenue for Hershey's has been 100% of total revenue. That tells us that that's their only revenue stream. You can either drag it all the way down like I've done and clear out these rows where you get these funny divide by 0 errors, or you can enter the average formula twice, once on the first line of the balance sheet and once in the first line of the income statement. All right, there you go. That's creating your common size statement. That's the first part of project 2. Happy calculating.